All right, class. So now we're looking at chapter 5. And chapter 5 is dealing with cost, volume, profit analysis, which helps managers to understand the interrelationships between cost, volume, and profit by focusing their attention on the interactions between the prices of products, the volume of activity, per unit variable costs, fixed total fixed costs, and the mix of products sold. It is a vital tool used in many business decisions, such as deciding what products and services to offer, what prices to change, what marketing strategy to use, and what cost structure to maintain. And I believe this week, with your discussion, one of the things that I'm having you look at is looking at a lot of the fast food restaurants and how they have the dollar menu or the value menu, and thinking about how they could possibly do that and still make a profit, right? We wonder that. Like, how can they do that and still make a profit? And what we're looking at today will help us to answer that. So let me go ahead and share the screen. All right, so there are three basic assumptions that we're going to use in order to help us to make these calculations and this analysis. So the first one is that the selling price is constant. So meaning that the selling price would stay the same for the product or service regardless of the volume. Also, that costs are linear and can be accurately divided into variable and fixed components. The variable costs are constant per unit, and the fixed costs are constant in total over the entire relevant range. And then in multi-product companies, the mix of products sold is going to remain constant. So one thing to realize is that nothing is sacred about these assumptions. When violations of these assumptions are significant, managers can and do modify the basic CVP model. Spreadsheets allow practical models that incorporate more realistic assumptions. So, for example, if we had nonlinear cost functions with step fixed costs can be modeled using an if-then analysis function within Excel. But just be aware that for the most part, this will be what our assumptions are. So now the contribution margin, CM ratio, and variable expense ratio. So variable expenses as a percentage of sales are referred to as the variable expense ratio. And so in our example here, we see that the racing bike company, or RBC, sells 1,000 units with 200,000 in sales and 120,000 of variable expenses. And so the variable expense ratio, we would take 120,000 divided by 200,000, or 60%. So now the CM ratio is calculated by dividing the total of the contribution margin by the total sales. So the contribution margin is 60%. That's what we just calculated here, or the contribution margin. So if we take that and divide that over the sales, then we'll get the ratio, the CM ratio. And so for RBC, the CM ratio is 40%. Thus, each dollar in sales results in a total contribution margin increase of 40 cents. So we see that we take 80,000, which is the contribution margin, which is the difference between the sales and the variable expenses, and then divide that over the amount of sales. So 80,000 divided by 200,000, which is 40%. So the CM ratio can also be computed by dividing the contribution margin per unit by the selling price per unit. So 200 by 500 is going to be 40%. So we sell the units for 500, but the contribution margin per each unit is 200. So if we can do that, then we can figure it out the same way, that it's 40%. Now, the contribution margin ratio and the variable expense ratio can be mathematically related to one another. So the CM ratio equals 1 minus the variable expense ratio. And we can see here how we can break that down. Thus, if RBC increases sales from 400 to 500 bikes, the increase in a contribution margin, 20,000, can be calculated by multiplying the increase in sales, 50,000, by the CM ratio of 40%. So 40% of 50,000 is 20,000, and we can calculate that. Now, the relation between profit and the CM ratio can also be expressed in terms of the equation that we see here. So, for example, our profit equals our CM ratio multiplied by sales minus whatever our fixed expenses are. So, for example, if RBC increased their sales to 500 bikes, what would management expect profit or net operating income to be? So 40% times 250,000, that's 100,000, minus the 80,000 is going to be 200 in profit. Okay, let's do a quick check here. So Coffee Clash is an espresso stand in a downtown office building. The average selling price for a cup of coffee is $1.49, and the average variable expense per cup is 36 cents. The average fixed expenses for the month are $1,300. An average of 2,100 cups are sold each month. And so what is the CM ratio for Coffee Clash? And so in order to do this, we're going to take our CM ratio, we're going to calculate it by taking our unit contribution margin divided over the unit selling price. And so the contribution margin is going to be our selling price minus our variable expenses. So so $1.49 minus 36 cents is $1.13. We're going to divide that over our selling price, which is $1.49, which is going to be 0.758 or almost 76. So it'd be 76.76 if you were to round. So our answer would be B, 0.758. All right, so the basics of cost volume profit analysis. So the contribution format income statement is going to be helpful to managers in judging the impact on profits of changes in selling price, cost, or volume. For example, let's look at the hypothetical contribution format income statement for Racing Bicycle Company, or RBC. Notice that the ellipsis is on cost behavior. Excuse me, the emphasis is on cost behavior. Variable expenses are separate from fixed expenses. And also the contribution margin is defined as the amount remaining from sales revenue after the variable expenses have been deducted. So we see here that for the month they sold 500 bikes, so they sold a total of 250,000, less the variable expenses of 150. So the contribution margin is going to be 100, and then minus our fixed expenses of 80, our net income is going to be 20,000. Now, the contribution margin is going to first be used to cover our fixed expenses. And then whatever is left from that then would be our net operating income. Sales, variable expenses, and contribution margin can also be expressed on an as per unit basis. And so, for example, for each additional unit that RBC sells, $200 more in contribution margin would help to cover fixed expenses and to provide a profit. And so we see that. So each unit, we sell each bike for $500 a piece. Our variable expenses are $300. And so our contribution margin then for each bike would be $200. So $200 of each bike contributes to our fixed expenses. That's what's left after our variable expenses are paid. So notice that each month RBC must generate at least 80,000 in order to cover the contribution margin to break even, which is the level of sales that profit would be zero. So they have to have at least 80,000 in a break even point in order, or contribution margin, in order to cover their fixed cost. Anything above that is their net operating income, but they have to at least have a contribution margin of at least 80,000. So let's see what would happen if RBC only sold 400 bikes in the month. And so if they were to do that, it would be operating at the break even point, meaning that they would make, after they paid their uh, variable expenses, they would have exactly 80,000 left over to cover their fixed expenses, but then they would have no operating income. So they wouldn't be operating at a profit or operating at a loss. Now, if they were to sell 401 bikes during the month, then they would have $200 of operating income at the end. Okay. So this is just an important concept for us to understand, the break even point. But obviously, the goal of business isn't just to reach break even. The goal of the business is to earn a profit. But it's important to understand at least what the minimum is. So as a manager, and you know what you have to do in order to reach a certain level of net income in order to be able then to meet your goals of what you're trying to do. And that's why we go over this. Now, we do not need to prepare an income statement to estimate the total, to estimate profits at a particular sales volume. We can simply multiply the number of units sold above the break even by the contribution margin for each unit. And so we see here that if RBC sells 430 bikes, its net operating income would be 6,000, because we take 30 units, which is the amount over break even, because break even would be 400 units, but 30 over that times $200 per unit, which is a contribution margin, and we can get to 6,000. Now, CVP relationships in equation form for those who prefer an algebraic approach to solving problems in a chapter. So this is just a way that you can do it. So you can work it out either as we did in the table, or you can work it out algebraically, whichever you prefer, that would make it easier for you to understand. Okay. So again, the contribution format income statement can be used to express the equation that we see here. So the equation is our profit or net income equals our sales minus our variable expenses. Notice that that is in parentheses, so we would calculate that first, and then we would then subtract our fixed expenses, and that would be what would get us our profit, or our other way of saying profit would be our net income. So you can use either way. You can use the contribution income statement, or you can use the equation. So let's look at an example using the equation, the same examples we looked at earlier. So this equation can be used in order to figure out what the profit would be if RBC was to sell 401 bikes. Notice the answer of 200 mirrors what we had figured out previously. So our sales would be 401 units times $500 a piece, which is 200,500 minus our variable expenses, which is $300 a unit. So 401 units times 300, which is 120,300. And then our fixed expenses, which are fixed, so they're going to remain the same regardless at 80,000. And so if we figure out what's in parentheses first, minus the 80,000 from it, then we get $200. And that would be what it would be left after we sold 401 units. So when a company only has one product, we can further refine this equation as shown. So you can take P multiplied by Q, so the quantity sold by multiplied by the selling price, and then subtract that from the variable expense per unit, which is V, times the quantity sold minus the fixed expenses. So if it is only one product, then you can also go ahead and break down your sales and your variable expenses like this. So again, we see in this equation that, again, just showing you another way that you can break it down, that we have our P, which is this selling price, which is $500 multiplied by the number of units, which is Q, which is 401, or excuse me, the quantity. So the selling price multiplied by the quantity. So P is the selling price, Q is the quantity that was sold, which is 401. And you would solve for that first. And then we have the V, which is the variable expenses per unit, which is $300, multiplied by, again, the number of units that are sold, which is 401. You'd solve that first, and then subtract the two. And then you could subtract your fixed expenses, and that would be how you could figure out how much, if they sold 401 bikes, which would be $200. Remember that 401 is one unit over what the break-even point was. So the profit equation can also be expressed in terms of the unit contribution margin. And so we can figure out the unit. So again, the unit, it's often useful to express the simple equation in terms of unit contribution margin. So the unit contribution margin is the selling price per unit minus the variable expenses per unit. So that would be the unit contribution margin, which is the selling price, which is P, minus V, which is the variable expense per unit. That comes out with that. So what we can do then is just figure out our profit is the unit contribution margin multiplied by the quantity. And then we could subtract from that our fixed expenses, and that would get you your net income or your profit. And again, to see it broken down for this example, if we sold 401 units, is P minus V, which is 200. So 200 times 401 is 80,000. And so 80,000 and 200 minus 80,000, our profit or net income is going to be 200. And this equation can also be used to calculate their $200 profit if it was to sell 401 bikes. All right. So now operating leverage. Operating leverage is the measure of how sensitive net operating income is to percentage changes in sales. And so operating leverage is calculated by taking the contribution margin dividing over the net operating income. And that is the degree of operating leverage is the measurement at any given level of sales of how a percentage change in sales volume would affect sales. So we see here in this example that, again, if they sold 500 bikes, we had sales of 250,000 less the variable expenses of 150, leaves a contribution margin of 100,000. less their fixed expenses of 80,000. So that leaves a profit or a net income of 20,000. So the degree of operating leverage, you have 100,000 divided over 20,000 is going to be 5. So the operating leverage is 5. What this means is that with an operating leverage of 5, if RBC was to increase their sales by 10%, then the net operating income would increase by 50%. And we'll look at that. How would we verify that and check that? And we can do that thusly. So we can prepare a contribution approach income statement. So again, if you were to take 50% of or 10% of sales, which is going to be 50 more bikes. So at 500, 10% of that is 50. So to increase it to 550 bikes, we would have sales of 275,000, less our variable expenses of 165,000. Our contribution margin would be 110. Our fixed expenses are fixed, so they're going to stay the same regardless of the level of activity. And so our net operating income then would be 30,000, which would be a 50% increase in income from 20,000 to 30,000. Okay, so let's do a quick check now. So if Coffee Clash is an espresso stand in a downtown office building, and again, the average selling price for a cup of coffee is $1.49, and the average variable expense per cup of coffee is 36 cents. The average fixed expense per month is 1,300, an average of 2,100 cups were sold. What is their operating leverage? And so it would be 2.21. And that is calculated by taking the contribution margin, which is the sales less the variable expenses, which comes out to 23.73, divided over the net operating income, which is 1,073. And so that comes out to 2.21. And then also, if they were to increase their sales by 20%, then how much should net operating income increase? And we can do that by taking the increase in sales 20% times their degree of operating leverage, which is 2.21. They would increase their profit by 44.20%, which is the answer D. And then we can verify that in order to calculate it. So we see then that a 20% change in sales would go from 2,100 cups to 2,520 cups. Our sales would increase from 3,129 a month to 3,755. Our variable expenses would increase from 756 to 907. Contribution margin would increase from 23.73 to 28.48. Remember, our fixed expenses, they're fixed, so they're going to stay the same regardless. So that's 1,300. So then our net operating income would increase from 1,073 to 1,548. And that works out to a 44.2% change in our net operating income. One thing to note here again is that the degree of operating leverage, it is not a constant like the unit variable cost or the unit contribution margin that a manager can apply with confidence in a variety of situations. The degree of operating leverage depends on the level of sales and must be recomputed each time that the sales level changes. Also note that operating leverage is greater at sales levels near the break-even point, and it decreases as the sales and profits rise. So just kind of keep that in mind as we do this. Break-even analysis. Now, again, for a business, their goal obviously isn't to break even. Their goal is obviously to earn a profit. But break-even point is important because it can help you to know what, at least at a minimum, you have to have And then you can go from there in order to figure out, okay, I want to make this amount of money. What am I going to have to do in order to do it? So the break-even point is useful to us, but obviously that isn't our end goal usually. At least for a for-profit business, it's not our end goal. So the equation and formula methods can be used to determine the unit sales and the dollar sales that are needed to achieve a target profit of 0. And so again, if we look at our example for RBC again, we see that. So we see that in order to do that, they have to sell at least 400 bikes. So we see that. So now if we suppose that they want to know how many bikes must be sold to break even, which would be to earn a target profit of 0, the equation shown on this slide would help us, can be used to get that answer. So the profit equals, which the profit would be 0, because they're just trying to break even, is our unit contribution margin times our quantity minus our fixed expenses. And you can calculate that out. And we can do that as follows. So if we know our profit is 0, we know our units contribution margin is 200. So we want to, and we know what our fixed expenses are, which is 80. So we're trying to solve for Q. So if we take 80,000 divided by the 200, then we get that we have to have 400 units. So the formula method can also be used to determine that 400 bikes must be sold at break even. So we can also use our fixed expenses divided by the unit contribution margin. So 80,000 divided by the contribution margin, which is 200, gives us also the 400 units. So either way you can use to figure it out. Now, suppose that RBC wants to compute the sales dollars required to break even. So for example, to earn a target profit of 0. And the equation shown here would be able to help us to calculate that. So again, we have our profit equals our contribution margin times our sales minus our fixed expenses. And so what we're trying to find out is how much in sales we want. And again, this is something that more likely as a manager you would want to know is what level of sales are required. So we know our profit we want is 0, contribution margin is 40%, fixed expenses is 80,000. So we're going to take 40% times our sales equals 80,000. So we just divide that. So 80,000 divided by 40%, our sales would have to be at 200,000. Then we can also use the formula method in order to determine the sales of 200,000 that will enable the company to break even. So again, you can take your fixed expenses divided by your contribution margin. The fixed expenses were 80,000. We said the contribution margin was 40%. So the dollar sales that we would need would be 200,000. So let's look again at using our Coffee Clash example of this. So Coffee Clash is an espresso stand, as we said, and I'm not going to read all of this, but we want to know what the break-even point is. And so in order to calculate that, we're going to take our fixed expenses divided by our contribution margin ratio that we already had calculated previous. So 1,300 is our fixed expenses, and they told us that. And then the contribution margin ratio we figured earlier is 0.758. If we divide those out, then they have to have at least 1715 in sales. So 1715 is the break-even point that they would need in sales in order to cover all of both their variable and their fixed expenses. Let's say that they want to know, rather than dollars, they want to know how many units they have to sell. In this case, they are selling cups of coffee. How would we calculate that? So again, we have our fixed expenses divided over a contribution margin per unit. So our fixed expenses were 1,300, and then we figure out the contribution margin per unit by taking our selling price minus our variable costs, which is $1.13 a cup. So we take $1,300 divided by $1.13 a cup, comes out then that we would have to sell 1,150 cups of coffee in order to be able to break even. So now we will compute the margin of safety and explain how that is helpful to us as a manager. So the margin of safety in dollars is the excess of budgeted or actual sales over the break-even point. It is the amount by which sales can drop before losses are incurred. The higher the margin of safety, the lower the risk of not breaking even or incurring sales. And so again, the margin of safety in dollars is calculated by taking our total sales, subtracting our break even in sales. And that gives us what the margin of safety. But again, so this is helpful to us because we're trying to figure out how much over the break even we have. And again, obviously our goal isn't to break even, our goal is to make a profit. But so this is one way that we can look at it. So for example, if we assume that RBC had an actual sales, as we talked about, of instead they sold 250,000 in units, given what we've already determined that the break even point to be 200,000, then the margin of safety is 50,000. Okay. And we can, again, we see that, and then we can break it down in order to figure out then what the net operating income is, what the contribution margin is, and so on and so forth, like we've been doing. And so for this, if they were to sell 500 units, we can calculate then that the margin of safety, we could also express it as a percentage. So over here, we did it in dollars, which is 50,000, because 50,000, 200,000 was our break-even point of sales. So 250,000 is 50,000 over what our break-even point was. We can also calculate that in terms of a percentage. And so we see that in this example, the margin of safety is 20% of sales. So 50,000 divided by 250 is 20%. Now we can also express it in terms of the number of units sold. Notice that break even was 400 units and we sold 500 units. And so the margin of safety thus would be 100 units. And we can calculate that by taking the 50,000 divided by the 500, which is the selling price. And that gives us 100 bikes. So we'll do a quick check, again, looking at our coffee clash example. So again, we want to know what the margin of safety expressed in the number of cups is. And so for them, we're going to take their total sales minus how many they would have to have for break even. So they sold 2,100 cups during the month, and they had a break even of 1,150 cups. So if we subtract those two, we get that they had a margin of safety and a number of cups of 950 cups. So they sold 950 cups over what it took for them in order to be able to break even. All right, target profit analysis now. And again, this is another thing that, again, as a manager, you're going to want to know, and it's going to help you. So in target profit analysis, we can estimate what sales volume is needed to achieve a specific target profit. We can compute the number of units that must be sold in order to obtain the target profit using either the equation method or the formula method, and we'll look at both of these. But again, this is something, obviously, as a manager, you have an invested interest of wanting to know. You want to know how many units are you going to have to to sell, or how many dollars are you going to have to sell in order to reach what, you have a certain amount of profit in mind that you're trying to reach for in that month or that quarter or that year. You're going to have to figure out what are you going to have to do in order to reach it. So we'll look at the equation method first. So the equation method is summarized on this slide. And for us, our goal is to solve for the unknown, which would be Q, which would be the number of units that we need to sell. And so in order to calculate this, we're going to take our contribution margin times Q and minus our fixed expenses. And that will get us then and we know what our target profit would be. So we could just kind of, for the most part, plug and chug and figure out how to be able to do this algebraically. And so we'll see an example of this. Let's say that RBC wanted to know how many bikes they would have to sell in order to earn a profit of 100,000. We can just go ahead and plug and chug and calculate this algebraically. So we have our profit, which is 100,000, and then we know our contribution margin is it's $200 a bike. We don't know we're trying to figure out how many bikes we have to sell. So we'll leave that as Q, and then we'll subtract 80,000. So again, we can work this out to say then that 100,000 plus 80,000, you would solve for that first, would be 180,000, divide by 200, gives us that we would have to have 900 units that we would have to sell in order to make a target profit of 100,000. And then we can also figure this out using the formula method as well. You can use either one. They both give us the same result. And so the formula method is shown here. It can also be used to compute the quantity of units that must be sold. So again, you can work out via the equation method or the formula method. Either way, you can do this. And so you take your target profit plus your fixed expenses divided over the contribution margin per unit. And so to figure that out, because again, we're trying to solve for how many units we'd have to sell. So we have 100,000 plus 80. So 180 divided by 200, which is contribution margin per unit, gives us the 900 units. So either way gets you the same answer. Just do whatever makes the most sense to you to calculate that. Now, so that was the number of units. You may want to also know then knowing the number of units is very helpful, but also you may want to know how much dollars in sales you would need. So let's look at how we can calculate that, but very much in the same way. So for this, what you would do again is just kind of plugging in our numbers. Our profit that we want is 100,000. Our contribution margin is 40%. We need to know the sales. So we'll say, sales. That's what we're solving for, minus our fixed expenses. So we have 100,000 plus 80. We do that first. So 180 divided by the 40% is going to be 450,000 in sales. So this is the equation method, and this would be the formula method. And you can do that. Again, works out the same way. So 100,000 plus 80,000, which is our target profit plus our fixed expenses, divided by our contribution margin, gives us our dollar sales, 450,000. So either way, because again, knowing the number of units is helpful, but also, and that tells us one thing, but also knowing a dollar amount in sales. That also, so both of these are important for us as a manager to be able to solve for. Okay. So let's do, again, look at a quick check, one of our little examples here. So Coffee Clash, again, we're going to use the formula method in order to determine how many cups of coffee they would have to sell to obtain a target profit of $2,500 per month. They want to have 2,500 a month in profit. And so to do that, we're going to take the 2,500 plus our fixed expenses, which is 1,300, divided by our unit contribution margin, which is $1.49, which is our selling price, minus our variable expenses, a cup of 36 cents. So we're going to take 38,000 divided by $1.13. So we would have to sell 3,363 cups of coffee during the month in order to have a target profit of 2,500 per month. Then we can also figure out how this is the formula method for figuring out how much in dollars in sales we would need. And so again, 2,500 plus 1,300 divided by, again, the contribution margin ratio, which is 0.758. We worked that out previous. So we take 3,800 divided by 0.758, gives us that we would have to have $5,013 in sales in order to be able to reach that target profit of 2,500 in the month. Okay, so now we're looking at some different applications for CVP, or cost, volume, and profit concepts. And then one thing to note here is that the 5 examples that we will discuss should indicate to you that the ranges of uses of CVP analysis, in addition to assisting management in determining the level of sales that are needed to break even or to generate a certain dollar amount of profit. These examples illustrate how the results of alternative decisions can be quickly determined, because we want to figure out, what would happen based on the different alternatives that we have. And again, as a manager, that's something that you're going to be charged with in order to be able to do. So let's look at this first example. We want to know what the profit impact would be if RBC can increase the sales units from 500 to 540 if they were to increase their advertising budget by 10,000. So they're trying to figure out what their sales would be if they were to increase their advertising budget. And the advertising budget would be our fixed expense. So we're increasing our fixed expense. And so we can prepare a contribution format income statement to show that that would decrease our profits by $2,000. So again, taking that, we see that we see here how we can do the contribution format income statement. And so we see here. So in order to do this, we're going to take, if they increase their sales, the number of units by 40 units, they would have sales of 270,000. Their variable expenses would be 162,000. The contribution margin would be 108,000. But remember that their fixed expenses are going to increase because the fixed expenses were 80, but we're adding 10,000 in advertising to that. So now it's 90. So given that, then the net operating income would actually decrease to 18,000. And kind of a shortcut way that we can calculate this is by taking the increase in the contribution margin, which is the 8,000, but we had the increase in the advertising expense, which is 10, and subtracting the two gives us the decrease in the contribution margin. Now, let's say that we were to have a change in our variable cost and also in our sales volume. So we want to know, what is the profit impact if RBC was to use a higher quality raw materials, and it would increase their variable cost by $10. But it would also, in doing that, would also increase their unit sales by 80 units. So they're actually able to sell more because the bikes now are of a little bit higher quality. And we can calculate this out uh, based on the contribution format income statement, we can we can see that going from 500 units to 580 units increases our profit, our sales to 290,000. Our variable expenses would increase, so it'd be to $310 a unit instead of I believe it was 300 before. So it'd be 179,800. Contribution margin would then be 110,200. Our fixed expenses we haven't changed. It would actually increase our net income by 30,000 or to 30,200, or it would increase it by 10,200. So now what would happen if we change our fixed cost, our sales price, and our sales volume now? So if we were to cut our selling price by $20 a unit, if we increased our advertising budget to 15,000 per month, and we were to increase sales from 500 to 650 per month, we can go ahead and calculate based on our doing a contribution uh, format income statement. We can take our sales, which would increase to 312,000. Our variable expenses would increase by 195,000 based on the number of units. We're selling more units. Our contribution margin then would be 117,000. Our fixed expenses are increasing because we're increasing on our advertising, 15,000 in advertising. So our fixed expenses would be 95,000. So our net income would be 22,000. So doing all of those things would only increase our net income by $2,000. And then we'll look at another example, changing the variable cost, our fixed cost, and our sales volume. So what would happen if they were to pay a $15 sales commission per bike sold instead of paying a salesperson a fixed salary, which is right now 6,000 per month. So rather than a fixed salary, they're going to pay the salesperson based on commission, and they increased the unit sales by 500 units to 575 units. And we see that the again the number of the sales to go from 500 units to 575 units is going to go to 287,005. Our variable expenses would increase because of the commission, would increase from to 181,120. Our contribution margin would would go up to 106,375. Our fixed expenses would decrease because we're no longer paying a commission as part of that, a commission, or not commission, but the salary, which was part of our fixed expenses. So from 80,000 to 74. So it would increase our net income to 32,375. So it would actually increase our net income by 12,375 units. And then if we just simply were to change our selling price. So if RBC has an opportunity to sell 150 bikes to a wholesaler without disturbing sales to other customers or fixed expenses, then what price would it quote to the wholesaler if it wanted to increase monthly profits by 3,000? And so if we were to do that, if we're going to sell, we want to increase our profit by 3,000. So if we take 3,000 divided by 150 bikes at $20 a bike, our variable cost per bike is 300. So then the selling price required would be a minimum of $320 per bike. And again, because our fixed costs are going to stay the same regardless. So then 150 bikes times 320 per bike is 48,000 in sales. Variable cost would be 45,000 to manufacture the bikes. So then our increase in net income would be 3,000. So structuring sales commission. Now, companies generally compensate salespeople by paying them either a commission based on sales or a salary plus sales commission. Commissions based on sales dollars can lead to lower profits in a company. So just be aware of that if it's only based on sales dollars, then it can lead to lower profits in the company. So sometimes companies will do a combination of both. Let's look at an example. Pipeline Unlimited produces two types of surfboards, the XR7 and the Turbo. The XR7 sells for $100 and generates a contribution margin of $25. The Turbo sells for $150 and it earns a contribution margin per unit of 18. The sales force at Pipeline Unlimited is compensated based on sales commissions. So based upon that, if you were on the sales force at Pipeline, would you push hard to sell the Turbo even though the XR7 would earn a higher contribution margin per unit? And so to eliminate this type of conflict, commissions can be based on the contribution margin rather than on the selling price alone. Because if it's based on the selling price, then obviously you would try to sell the one that cost more, but realizing that the one that costs more does not, it actually contributes less to the company than the one that sells for a little bit less. And so in order to do that, you can base the commission on what the contribution margin is rather than on the sales price. Okay, so now we're going to look at the relationships in a graphic form. And so the relationship among revenue, cost, profit, and volume can be expressed graphically by preparing a CVP graph. Racing Bicycle developed contribution margin income statements at 0, 200, 400, and 600 units sold. And so we can use this information to prepare a CVP graph. And so we see here what would be at 0, what would be at 200, what would be at break even, and what would be at 600 units. All right. One thing to be aware of is that the graphic form of CVP analysis may be preferable to you if you are uncomfortable with algebraic equations. So if you can graph it out, then it makes it a little bit more visual. You can see it. So now in a CVP graph, the unit volume is going to be expressed in the horizontal or x-axis. So going along the bottom, you're going to see the number of units, and then going along the side, which is our vertical axis, we're going to have dollars. And so the first thing we need to do is to draw a line parallel to the volume axis that represents the total fixed expense. And that's what we've done there with the red, is to calculate our total fixed expense. And remember, the fixed expense is going to be fixed regardless of the number of units that we sell. So the next thing that we want to do, which is the blue with the little squares, is to choose sales volumes at that and plot the total expenses. And so we're graphing then the total expenses So we have then the fixed plus the variable. And we can do that for each range of the number of units that are sold. And then we can calculate then the next thing that we need to do there is to go ahead and choose our sales volume and then plot the amount of total sales dollars. And then draw a line through the data points back to the origin. And so that is with the green with the little circles, which are our sales, the amount of sales at each one of these different points. Then what we can do then is we go to interpret the graph. The break-even point is going to be where the total revenue and the total expenses will intersect. And so in this example, we see that the break-even point would be 400 units, which is 200,000 in sales. And we see that that is where our sales and our expenses, total expenses, where those two lines on the graph intersect. And anything above that is our profit area. Anything below the break-even point is our loss area. Before we move on, what do you think about what the CVP graph would look like for a public agency such as a community hospital, where they would receive a fixed budget within each year? And then if they also are collecting fees that are less than the variable cost, what would that look like? And so this is the reverse of the usual situation. If such an organization has profit above the break-even point, it will experience financial difficulties because they're collecting less than what its variable costs are. So they would be operating at a loss. So it's just something to kind of think about, that obviously they're given a specific budget, but then covers their fixed cost, and then they have to cover for their variable costs. But after a certain point, they're getting less than what their variable costs are. They're going to be in trouble in the example. So, but in this case, we see normally how it works. Now, an even simpler form of the CVP graph is called the profit graph. The profit graph is based on the equation that is shown on this slide. So to plot the graph, we would compute the profit at two different sales volumes, plot the points, and then connect them with a straight line. This slide contains the profit graph for our RBC. And then we see here that the sales volume plotted on the graph are for 300 and for 500 bikes, and the break-even point is 400 bikes. So 300 bikes, we know we would be at a loss, and then at 500 bikes, we would have 20,000 in profit. At 400 bikes, we would be at zero profit. All right, so the concept of sales mix. The term sales mix refers to the relative proportions in which a company's products are sold. Since different products have different selling prices, variable costs, and contribution margins, when a company sells more than one product, break-even analysis becomes more complex, as this following example illustrates. So we see here that RBC, if they sell both bikes and parts, what would happen? And so again, for these calculations, they assume a constant sales mix. The rationale for this assumption can be explained as follows. To use simple break-even and target profit formulas, we must assume the firm has a single product. So we just do that, assume for multiple product companies. The trick is to assume the company is really selling baskets of products, and each basket always contains the various products in the same proportion. So you're otherwise it's going to be you're not going to be able, we just have to make some assumptions to be able to figure this out. So we'll see an example here. So assume that RBC sells bikes and carts. The bikes comprise 45% of their sales, total revenue, and the carts comprise the remaining 55%. And so the contribution margin for both products combined would be 48.2%. And so we can calculate that based on for the bicycles, for the carts, and then average those two together, we get what it would be for the total. So we have contribution margin, or sales for both. Yeah, contribution margin for the total would be 256,000, and then total sales would be for both products would be 550,000, comes out to 48.2. So then we can calculate then the break-even point for sales would be at 352,697. The bikes would account for 45% of this amount, or 158,714. The carts would account for 55%, or 193,958. And then notice a slight rounding error of 179. So it doesn't work out exactly to find out what the break even is, but we can do that. Take the fixed expenses divided by the ratio that we calculated, so 170,000 divided by 48.2 comes out to 352,697 in sales. Minus our variable expenses give us the contribution margin of 170,176. And 170,000 is our fixed. So there's just a little bit of error there, but it gets us close enough that we can get an idea of what we would have to do. So the next thing that we're going to look at is the idea of what is called a mixed cost. And so a mixed cost is where the cost would contain both variable and fixed elements. And there might be times where that happens, and that'll be our next segment, and we'll take a look at that, what we would do in that situation, how that behaves.